All right, welcome everybody to the mailbag for what is it? It's almost the end of the month here, man. It's almost November, right? Thursday, November, whatever. Baidu just came out with earnings.
Oh,
Baidu just came out.
ah,
Stock is getting trashed right now, down to 211. I don't know what
mm,
the actual earnings are. We're going to talk actually about earnings. Me and Brian are going to talk a little bit about how to price these things or finding the expected move. We got a couple mailbag questions on
ooh,
that. Anyways, let's talk real quickly about the FOMC release here. They said they're going to end QE. Obviously, QE is completely over. They talked about, raising interest rates, which helped a lot of the bank stocks out. If you notice, Bank of America is back to $17 after being at like 15 and a half. Once the market panic took place. Citigroup is also looking good. Goldman Sachs is almost back to 187. So there's a lot of bullishness here in the financials. Also, if you look at the credit cards, Visa reported earnings after the close today. That thing's up like 8 points. And if you look at like months of activity on this thing, she hasn't done a damn thing. And now finally, she's back over 220. So this could be an interesting thing to watch, as we get into December. So, Brian, what's going on over there in your world, man?
what is going on? I don't know. Just fucking going, doing shit, doing all types of things, doing some algos.
Cool.
Yep.
Very cool. All right, so let's get right into these questions. So we have a bunch of questions here. We got some questions from our boy Q, who is an astute member of the Sang Lucci chat rooms. It appears that a market maker can pin an equity for several hours and seem to get away with it. How can one accomplish this type of size and market inflexibility? So basically, he's asking assuming we believe in this whole pin theory. I mean, there's levels to the pin theory which Brian and I, will obviously argue back and forth on. But Brian, how can a market maker, or let's say a collection of market makers, hold the price of a stock at a certain level to achieve some desired effect? Or how can any entity do something like this?
All right. Well, let me just tell you this. If you
Cool.
are a market maker in options, we'll just say that's the case. So again, all right. Let's start from the beginning. Actually, a lot of people sell options. These market makers are along them, and yeah, they're sucking on this decay. So they have to gamma hedge, and what happens is that their gamma hedging is based upon time and implied volatility. And so essentially, based on a calculation, a formula, we drift below the strike. They have to buy their shares of stock because it's time. They have an alarm. It's time to gamma hedge because the stock has moved enough. And everyone kind of has the same formula, and they use it, and so they all buy the stock together, and it sends it back up. And then the stock goes through the strike, and it goes above higher, and the same thing happens up on top, so it sends it back down. So the only way that it doesn't pin is if you have non-option market makers buying or selling the stock. That's the only way we don't pin, really. Or you have a pro that just wants to mess with you. Or the market maker says, you know what, screw it, I'm not going to sell the stock out for whatever reason. Maybe they have a signal that says we're going to continue to go up, so they don't sell it out. So they don't add to the pressure. They don't add to the volume that would send it back down towards the strike again.
So do you have, let's say, I mean, I'm just throwing this out there. Do you have, let's say, optimal places where the pinning will most likely start to happen, or are you thinking as far as that?
It's really open interest. If there's a lot of open interest, you know that there's a lot of market makers that are along these options that are going to expire tomorrow or today or whenever the case may be. Obviously, the closer you get to expiration and you're right near the strike, the more gamma you have, and there's more decay. So these market makers really need to monetize their gamma. They need to pay for the decay. It might look like they're sucking on decay because you're selling a straddle. You're not. Google was really good at this for the late 2000s, early 2000 teens, or whatever you call it. Um, you can rely on the stock ranging because the market makers have to monetize their gamma to pay for the decay. And, it's a reliable thing. But when you have manipulative HFT or you have manipulative paper, it could kind of move the market. But again, it's really about if there's strong open interest and there's not a lot of volume in the stock, most of the volume towards the end of the day at least is going to be the option market makers hedging to pay for that straddle going to zero. And if it
Okay.
doesn't, then the stock rips and they make money on the rest of their gamma.
Okay. All right. Well, Q, I would say for my answer to that question is, I mean, again, most of the time where we see pinning, or an equity just kind of stabilizing in price, is after a lot of things have happened to the option price. Let's say volatility spiked up, or let's say there was a nice delta move, in that particular stock. Things kind of flattened out, evened out a little bit, and then as you get closer to the expiration, just like Brian was saying, with a lot of open interest, if there's a lot of activity at these certain strikes, this is kind of where we see that activity happening. We got another one here. I've seen people talk about using options to figure out how much the market is expecting the stock to move during earnings. Can we give them just a little taste of this? This is something that Brian is able to teach, much more specifically, in the class that he has right now.
Right.
But let's see if we can run a quick example here. I mean, Brian, you take a look at this Baidu.
Yeah.
You see the options chain here. I mean, go ahead and just give us a quick and dirty way of how to look at the option chain and say, okay, they're pricing this thing to move
Right.
X, Y, and Z points off the earnings.
Right. So the key first thing you want to do is see what the straddle was last Wednesday at the money straddle. So Baidu was at 2.25, so 2.25. So we have 7.25, 6.5, 13.75. Say a $14 straddle.
Okay.
Say last week it was worth $4, or just say it was worth $4. I don't know what it was last Wednesday.
Right.
So that means there's a $10 move. $10 divided by 2.25 is like a little less than a 5% move. That's where people are putting this straddle at, and right now I guess we're down 4%. So that is pretty decently correct. Now the real way you do it is what's the implied volatility so today, say this morning we have 3 days left until expiration. What's the normal implied volatility? This is how they do it in market makers and pros. Say it's usually a 24 vol, and the vol right now is like 90 something. So basically, you have a 3-day option, and then you have an added on piece, which is the event vol.
Right.
And that's what you back out through this formula. So I can actually give that to you guys at some point if you want it. But that's what you do. You just back out from the implied vol today. And you got to know a general where should the implied vol be when it's not earnings week, and then you can back out what the pros, because the pros / market makers build up that implied vol to a certain level.
Right.
It's a general default, like it's going to be a 5% move. 5% is a general starting place for these tech names, and the pros add into or decrease that vol based upon where they predict the stock to move, or how much they predict the stock to move. And is it because they have insider information? Whatever the case may be, there's
Right.
money flowing towards that straddle, and that's pretty much it.
Right.
So it's kind of simple, but it's not.
Could you actually relate it to? And I mean, I'm just kind of reaching here, but I don't know how much. It's like the powers that be, right? The market makers are deciding how much more volatility to kind of price in, event volatility to price in. Is that similar to Vegas setting the lines here for the betting here, or is it more of a collective approach when we're talking about options here? So are we talking about some of these large market makers basically creating the ideal spread or the ideal move for these stocks. And then very infrequently do they miss on these, just like sports betting and stuff like that. Can you even make that correlation? Can
Yeah,
that correlation even be made?
it's actually perfect.
Okay.
So they set it like Vegas sets the opening line, right?
Right.
And then the pros affect the line. And so it's the
Right.
same exact thing. Now, how they set the line is based upon how is it's pretty much like what is the average move, seasonality adjusted possibly, most likely because as we see sometimes in the summer we don't move, whatever. So
Right.
seasonally adjusted average move, that's where we set things, and then the pros dictate how it moves up or down from there. And it's simple as that because the market makers are going with the flow.
Right.
They're not like, no, it's not going to move or it's going to move, so I'm going to put on a big position. They're like, is my risk look okay? If we don't move, am I going to get screwed? If we move, am I going to get screwed?
Right.
Just like Vegas, man. So yes, it's a good point. They set it like Vegas, and they let the pros move it, and they just go with it.
Great, great. All right, so we got another question here. How did you handle the post FOMC trading today? Once the news came out, most stocks were pretty weak, but the one thing that we saw across the board was that there was no aggressive selling. There was no aggressive selling across the board in any names. And on top of that, most of the banks were pretty bullish. Apple was also very bullish. Like the thing couldn't dump through 107. So, you had all these things happening, but you had some weakness in the market. And again, like shorts tried to get in. I tried to get in on the short side, assuming the SPY would actually just kind of pull back, finally start to pull back. But again, none of these names started bleeding off, and then that set up the nice algo spike, the sort of bear trap at the end of the day where everybody kind of gets short squeezed. So honestly, I think there's two scenarios here that end up happening here. One is we literally don't pull back and banks start taking us higher to all-time highs, or two, we consolidate for a while, you start seeing really, really, really choppy action, some pullbacks here and there, and then we still go to all-time highs. I mean, those are my two scenarios, so I guess I'm leaving it at that. Let's see. Yeah, that was the next question. Last question here. How do you approach earnings trading? Why do some names dump after a bad report, but others just end up rallying on the bad news? I mean, again, this is the market. This is the market. It's not a rational environment. I would say that if a stock is already priced in the bad news and the worst news, and the earnings is shitty, but it's not that bad, and all of it's already priced in, then of course we're going to rally on those news. Of course we're going to rally on that news. There's a lot of instances where you have stocks that are oversold. You come up with an earnings report, it's bad. Everybody knows it's bad, but they've already priced it into the stock. So now comes the squeeze, and everybody buys back in. Anything you want to add on that, Brian? Like, why do why?
Yeah.
It's basically, what is the game here?
Right. Okay. So
How would you approach earnings?
yeah. No. I mean, earnings are tough, man, because you see, there's great earnings, but it's all about what's the next quarter. What are you going to do for me
Right.
next quarter?
Right.
And if the projections aren't aligned for next quarter, so not only is it were the projections in line for this quarter, it really is more what are the projections for next quarter, and is that out of line? And if
Right.
it is out of line, meaning the analysts didn't project that the earnings are going to be even better next quarter. Maybe they were right about this quarter. Maybe they're in line. That's why people bought the stock, because analysts.
Right.
And then analysts thought it's going to be XYZ, but it's like 1, 2, 3 instead. And everyone's like, oh, wow, it's even better. And those analysts were correct about it going up. So that's when we have a real huge move. Or, they had bad, analysts thought it was gonna be worse than it was. So basically, you beat expectations by a whole lot, or you underwhelmed by a whole lot. And
Right.
what's it going to be next quarter?
What's it going to be? It's always the guidance, and
Yeah.
I would say to this question here is that the way that you want to approach it, like you want to go at it differently. Like earnings is a completely different way of trading here. You're not intraday trading here. What you're doing on these earnings calls is you're going back. You might be going back to historical earnings, going back 3 or 4 quarters. How have they done? What are all the analysts predicting for this particular quarter? What could happen to the forecast here for next quarter? What kind of environment are we in? What kind of a place are we in? Are we in a place where they're selling the news on good earnings and picking the stock right back up? Like a lot of times, you'll get a trend here just on how companies are reporting and the reaction to those earnings. So there's a lot of things that you have to take into consideration, and then on top of that, most people like what Brian and I just talked about the gaming aspect of the volatility or the pricing of the move when the earnings happen. It's already kind of caked in. And as Brian was saying, you need a better than expected. You need a worse than expected, a much more worse or better scenario to really get that spike up, which nobody was expecting. For example, like those Netflix earnings that came out, stock was what, $420. The damn thing dumped 110 points, and they only lost like they were only down. It was only a small downtick in their subscribers or whatever. The earnings report was fairly good. Was it? Should it have resulted in a 100-point, lop on price? Well, that's another story. But again,
that's why we're 50% retraced already. We've
right.
already retraced half of the move. So it's just about people's sentiment too. And it's about institutions as well. There might be some institution might have 1,000,000-something shares that they unload. And Icon might be right behind you. So watch out.
Right. All right, man. So that's it for the questions today, Brian. Do we have anything to add here about your class coming up? What do we got? What do we got going on in Sang Lucci?
We're gonna talk about dividends tomorrow. Actually, I'm gonna have a little webinar. So bring your questions, and Charlie wants someone to stump me on some option stuff, and we'll see if someone can, and step it up. Bring your questions.
So shout out to everybody out there. If you think you got some serious options knowledge, man, go try to step up with Mr. Weiner tomorrow. The webinar is what time, man? Is it
4 o'clock? 4:05. We're gonna try to get 4 o'clock right away. So we just take off like closing bell. Cool. Wipe my head off and just let's go. Let's talk about things.
Cool. Sounds good. All right. So again, he's going to be talking about dividends, how to play options to capture the dividend. Correct?
Yeah. I mean, there's certain things you can do to try to get free money, and I'll try to tell you how to get free money.
Cool. All right. And just to clue in here, Baidu is trading back to 223. She is absolutely flat here. So
I'm going to say something about that.
Sure.
If the market makers. The option market makers after hours are obviously going to, still be in the office. And if there's not a lot of volume, it's all about volume. It's all about the tape, right?
Right.
So, if there's not a lot of volume, those market makers, they're long the straddle. They have to buy, they have to edge. There's so much decay overnight tonight.
Right. If the stock you're saying does nothing, if the stock sits here and does nothing.
And they're long that at the money straddle. Well, say they buy it down here and it continues to go down. Well, there's another gamma hedge that they'll do some percentage later. These are standard deviation moves. But the thing is, if you don't buy that stock down here, and it rips back up, and it rips back up because there's not more pressure. It's just immediate reaction. We go back up to that straddle, you're decaying out your butt, and then they're going to be screwed on the morning.
Right.
So it's just.
So I mean, you're saying they'll go ahead, since there's not that much volume here on the stock or whatever. You're saying they'll come in after hours and they'll start hedging their position.
They will, in case people buy it back up, because if we open tomorrow unchanged, they're going to lose $10 on their straddle, man.
Right.
And you can't afford that. At least you have to subsidize it by gamma hedging. And what if it rips back up? I mean, I remember Amazon used to go the wrong direction.
Yes, always.
And then rip right back through.
Always, I remember.
Yeah, so you catch it. You buy. You're hedging, so you actually get to buy stock down here for free.
Right.
because you're supposed to be long or you're supposed to be flat, and it rips back up, and you get to make all this money, like $30 wide. That's a lot of money, you know. It pays for your decay.
Yeah, definitely. Is there a percentage calculation though where those hedge programs will trigger? So for example, like let's say again, market makers are long this straddle, they see the stock tank here, but then they see it kind of stabilize. What are they also do? Are they also just looking at price action just like you and I are to figure out like, okay, let's just start buying this stock to hedge here, or
They
what?
have a number. They have a standard deviation. It's based
Okay.
upon square root of time left before expiration.
Okay.
It's based upon implied volatility and percentage move. And so if you hit that threshold,
Right.
literally they'll be like, all right, buy however many shares you're supposed to buy.
Right.
Buy 2/3 of it. You know, it's
Right.
like a standard deviation. So you buy 2/3 of it, then you buy 90% of it. Um,
Now, do a lot of these guys? Here's another question, and again, I mean, I'm just kind of throwing it out there. Let's say they need to buy 2/3 position, however many shares that is. Now, since it's after hours trading, do they shop that order out, or do these
no.
guys trade it themselves? They trade it themselves.
When I was a clerk in 2000, I did hedging for like Cisco and Oracle and some of
Okay.
those whatever, even IBM and all that jazz. So
So you got a dude in house. You
I
got a
got a
dude in
dude
house.
sitting there, some trader trainee sitting
Right.
there bidding for stock.
Okay. All right. All
You
right.
know, and maybe he's good, maybe he's not, maybe he pulls.
All right, sounds good. That's it for the mailbag this week. Thank you, Brian, for joining us. Make sure you guys all attend Brian's webinar tomorrow. I'll be there as well. It's 4 o'clock after the close. Just check the Twitter feed for all the links, and we'll see you tomorrow. Bring it. All the options guys. All the options
Bring it.
guys out there who want to get a little bit more advanced in the terminology and such. Charlie wants somebody really bad, apparently, to stump Brian and put him in his place. So bring it tomorrow and try to check him. We'll see you tomorrow at 4.
Later.